So we take that 10 to 15% and we actually roll it back into the company. We hire people, better people. We pay them a little bit more. We do employee related events. We have a big Christmas party at the end of the year. We focus a lot on culture and internal growth so that while we're able to operate more efficiently than a property management company who needs that profit, it doesn't sacrifice on the execution side or the culture that we've created at BAM, which is one of our competitive advantage.
This is episode number 21 of the Multifamily Success Stories podcast. Would you like to turn vacant units into cash and earn up to 3 times more per door without having to do any extra work yourself? We offer fully managed short-term rental solutions for multifamily investors. Go to managedbylux.com for more information.
Hey, this is John Bell
and Julian Sage,
and welcome to the Multifamily Success Stories podcast. This is a show where we talk to multifamily investors about their journeys and starting and growing their real estate empires.
Our goal is that you'll be able to walk away not only inspired, but with practical information to help you in your real estate journey.
Since we are a new show, please go over to iTunes and leave us a review and let us know what you enjoy.
And if you haven't done so already, go on over to our Facebook group, the Multifamily Success Network, to connect with the community. Hey, what is going on, Dealmakers? Julian Sage here. And in this episode, I had the special honor of speaking with Ivan Barrett, founder of Barratt Asset Management, a multifamily investment firm that has $400 million of assets under management and 4,000 units primarily located in Indiana. BAM started as a multifamily management company that transitioned into syndications and has recently closed on a $50 million fund. Ivan shares his struggles of starting in management, how he grew his team, finding the right business partner, and raising capital as a 506c. If you like my show notes for this episode, go to multifsuccess.com/EP21, or if you like my show notes sent directly to your inbox every week, then go to multifsuccess.com/show notes. With all that being said, on to this week's conversation. Hey, welcome back, Dealmakers, to another episode of Multifamily Success Stories. In this episode, I have the special honor of speaking with Ivan Barrett. Ivan, would you please introduce yourself to the Dealmaker community, let them know who you are, and what inspired you to get into multifamily investing?
Hey, guys. Thanks for having me. Been looking forward to this podcast. Been watching on the calendar. Happy to be here. Ivan Barrett, my company is BAM. We manage about 4,000 apartments here in the Midwest. And I was inspired at a young age to be in multifamily. My dad had rental properties growing up, and my brother and I were his landscaping arm, meaning we got to mow yards for free at about age 7. It was a long time ago, but back then you could make your kids do manual labor without being reported to childhood services. So I got an early taste for real estate and thought, why would you want to get a real job when you could just own a lot of rental property and watch the cash flow come in? Turns out it's a real job, but it did firmly plant the real estate bug. And going to college for real estate, getting into the business, always had big dreams, big hopes to own large apartment communities, big, nice stuff.
So property management was how you first got into it. A lot of people, when I talk to them, they say, hey, property management, it's all a numbers game. You don't make any money when you're just, you just have a handful. Why go, if you wanted to ultimately get into multifamily, why go the management route?
Yeah. I mean, first, what you said is true. There's not a lot of money in managing property. But it's 2010 when I started. I'm coming out of the great financial crash, GFC, right? Probably the single greatest gift of my adult career was having a front row seat to that in my mid-late 20s, and really seeing the downside of real estate. I've been working for a mentor for about 8 years, decided to start my own company and wanted to grow it large. And I decided to model some other companies I saw out there that did well in the recession. And all those companies had their own management arms. So not really knowing better and not doing it because I loved it. I don't like dealing with the tenants and the toilets, like anybody else, but I knew I could charge a service fee for that. And I knew I could scale a business, something that would grow and generate monthly recurring income so that I could scale a business. because buying real estate, can be very slow. Whereas if I worked hard and courted investors and developed business, I could scale that monthly cash flow faster by managing properties for others. And I also figured if I could figure out the management side of it, the execution side, by the time I was ready to do bigger deals, that I would be more prepared to do so. And so I started very small, started buying small multifamilies while I was managing units for others as well, learning, making a lot of mistakes, taking my lumps on my own dollar, but scaling a platform that would grow into something that I wanted to get into. And for me, as an entrepreneur, starting from the bottom in my own spare bedroom, in fact, it made a lot of sense to me to do small deals, to get that momentum going, to build that track record, and to create those systems to grow a business. It seemed like the right path, versus trying to jump right into big deals, and then a year goes by and I haven't done anything, and then another year, and so on and so forth. So the taking action, the momentum, taking small steps and growing from there, worked for me.
So, during that time, a lot of people have said like, hey, that's where they saw some of the greatest growth. Why during that time did you feel that you wanted to go, start with a property management company and kind of, manage properties when a lot of people were, offloading them, when other people were also, maybe picking up really good deals, also?
Yeah, well, I started to pick up some great deals, but they were all small. By picking up clients that were landlords by necessity, they couldn't sell their house and needed to rent it out. Picking up investors that were buying properties and offering them a service that they needed allowed me to scale more quickly into the big stuff. So my first property was house hacking a duplex. Then I started renovating small doubles, duplexes, a triplex. Then I jumped up to 6 units. From there, I bought 35 and a 30. Then I said I'd never do another small deal again, but I bought 15 because it was too good of a deal to pass up. Then I syndicated a 60-unit deal in 2014, so about 4 years later. And then from there, started buying 100-plus unit projects and kept bending the growth curve. I think it was a great way to start, and I think it worked well. It doesn't work well for everybody, but it allowed me to build a scalable business. And now, at over 100 employees and about 420 million of assets under management, I've got a very unique story in my space in that I started off in the management side of the game, which is one of the key components to returning capital to investors, is that execution on the management side.
Do you think that it's, when you say that that's, you're unique in that you started with the management, why does having management play such an important role in your asset management company?
Well, right now, value add is a 3-legged stool. We're still getting, general rent growth here in the Midwest. So we're finding markets where the rent is growing organically. We're still able to find deals that can benefit from light value add. But that third leg, and very important leg to get our returns up into those mid to high teens returns annualized, is our ability to reduce costs on the management side. And having that internal team, we know exactly, for us, down to the penny. It's not a game of nickels and dimes for us. It's a game of pennies, and we know exactly, where to find those pennies. And every 100 pennies that adds up to $1 is a 18 multiple right now on a sale. So that management component has been very, very beneficial for our platform. We like control. My teams on site at those communities, they work for me. I sign the paychecks, figuratively, right? We don't sign paychecks anymore. But versus beholden to a third-party management company where my asset might just be another number, and that's another way that I can control costs. And we're one of the only companies out there that educates our our management teams at the site level on what owners look at and how we asset manage those properties all the way from the top down. And most of our PMs report back that they've never worked for a company that did that kind of training.
For clarity, you mentioned light value add. What do you consider a light value add?
Yeah, John. So right now we're looking for deals that are approximately 15 to 20 years old. They've got high ceilings. They've got good floor plans. They've got a pool. They've got a clubhouse. But maybe it's time for a clubhouse remake. Maybe it's time for new pool furniture. Maybe we're switching out appliances from white to black, countertops, that sort of thing, versus what we would consider like a heavy lift value add, where you're changing out the resident profile. You're doing more extensive renovations to raise rents.
And speaking of having your own management company in-house, have you ever
Yeah,
subbed your management out to anybody else and
never,
compared the cost? Okay.
never, never. Started from the bottom. Now we're here, man.
How big of an impact does having your own in-house management company affect when you are when you did switch over to vertically integrated asset management? Does that make a drastic difference towards investors, or is it something like, can you really cut that much fat from your own business without you bleeding?
Oh, no, great question. So we don't run it so slim that we affect the property or the type of people we get. I think the best way to answer your question, Julian, our management company is a loss leader. So if we were miserly and very, what's the word? I would like almost cost sensitive to where it would affect people, we could maybe squeeze out a 10 to 15% margin on property management. As I said before, the folks that have told you that there's no money in property management are correct. It's a very low margin business. Instead of taking that 10 to 15% profit margin and trying to squeeze the management company, its objective is not profit. Its objective is to be a beautiful machine of people that execute our business plan. So we take that 10 to 15% and we actually roll it back into the company. We hire people, better people. We pay them a little bit more. We do employee related events. We have a big Christmas party at the end of the year. We focus a lot on culture and internal growth, so that while we're able to operate more efficiently than a property management company who needs that profit, it doesn't sacrifice on the execution side or the culture that we've created at BAM, which is one of our competitive advantages. Thank you for asking.
So you said that you save around 10 to 15% by having your management company in-house as opposed to outsourcing that to a third party?
No, we don't save that 10 to 15%. We reinvest it into our people and the tools we give them and the leadership training we give them.
Correct. Okay. And with that, I also saw you invest very heavily in Indiana, Illinois, which is, you're actually one of the first guests on the show that's so heavily invested into that market. Usually a lot of people, they're in Texas or in Atlanta, South Florida. Why that particular market?
Yeah, so we've got one deal in Illinois, Southern Illinois, more of a red, landlord-friendly area of the state. It's okay. Market area, it's growing. It's got a good, stable market. We're pretty heavily invested in Indiana, and then we've got some assets in Ohio as well. You might not know this, but Indiana, both with Yardi and CBRE, is the top rental growth market in the country right now for multifamily rents. What's interesting about the Midwest, it's got a lot of things going for it. There's many markets, Indianapolis being one of the best ones, that has successfully decoupled from the Rust Belt moniker that the Midwest used to classify as. Logistics, finance, law, insurance, a lot of e-com. And it's not a boom market, like some of those others you mentioned, but it typically doesn't bust either. It's more of a steady eddy market. For example, Indianapolis has had for 35 years average rent growth of 2.9%. And we at BAM think we're better than average. So a market like that, as the value investors we are, our first rule, just like most value investors, is don't lose money, right? And rule number 2 is remember rule number 1. And rule number 3 is how do we find a return, or how do we get yield? So for that sort of investment thesis, Indianapolis for us makes a lot of sense.
Do you find that, you investing into a more moderate growth market, that it's a lot more competitive, or is it easier for you because you've been there for so long, as opposed to where most people are trying to look into those boom markets, like you said?
Yeah, competitive. I think we've got a pretty good reputation as local operators, so we typically are, at the top of the list when deals are on market. Indianapolis is one of those sneaky markets where a lot more people have, or a lot more operators have awoken to the fact of what its performance has been. I'm sure it's well, it is, as a matter of fact, lower. Or I should say higher cap rates than some of the other markets, by maybe 50 basis points. It still comes down to, in my business, finding areas where you can add value and force appreciation. If you can't do that, somehow, some way, you can't get those returns, north of 10% mostly. You have to find that value add, that scale, where you're adding dollars to the bottom line to do the, to force the appreciation. Otherwise, you're just buying yield, and that just doesn't work hard enough for my money or my investors.
And so around 2010, you started this management company. You said that you were picking up a bunch of smaller, 10, 16 units until around 2014. Why a 4-year period of doing a bunch of smaller deals while also managing the business? Why not, jump into something, a larger, 100 unit plus deal a little bit sooner?
I wanted to take a disciplined approach to scaling the company. So first I bought a 35, a 30, that 15 unit. Then I bought a 60. And then in 2000, late 12, I think it was, I bought my first 112 unit property. And we were starting to scale from there. I may have misspoke earlier. But my plan was to take these appropriate, in my opinion, disciplined steps on scaling up the business, because I knew I would make mistakes along the way. And, I really wanted to make those mistakes on small deals, medium-sized deals, learn from those mistakes before I started taking on a lot of investor capital. Because I'm sure, as you guys know, when you're out there raising equity, your track record and your reputation is everything.
So what were some of those first mistakes that you made?
Oh, how long you guys got? I mean, dude, I made every mistake in the book, John. Oh man, let's see. Thinking I was gonna make improvements out of cash flow. That's a big one. That was a struggle for a while. And what saved me on that deal was I was able to not charge myself management fees for 6 months while I was able to build up more cash. Management company saved my butt. Growing a management company, hiring people, learning how to grow a team, and finding good people, and me really becoming a good manager of people and a good boss. Most days, like, that learning curve made real estate seem easy. But I had to recognize it was just part of the journey. If I was going to grow a real company, was to learn how to be a better person personally, right? How to work on myself, be a better leader, be a better manager, and then continue to find people underneath me that would buy into the vision and help me take it to the next rung on the ladder, and then from there and so on.
Now, starting out, were you close to most of these properties, or were you kind of doing them still remotely, building your management team and having them manage?
I was all in Indianapolis. Yeah, I stayed really close. I tried to get, most of my first stuff within like a 20-minute drive or less. When I first started the management company, I was only taking on pretty much B plus rental properties where the resident cared about their credit, right? Because when you got somebody that cares about their credit, it's a little easier to collect the rent, right? So I waited till I had a little bit more scale and some more humans in the machine before we started taking on some C plus type properties, and continue to grow from there. But all the small stuff I managed was in the Indianapolis MSA. We didn't go outside of that until we started getting bigger and big enough to have on-site staff at a property. Now we
And
don't
during
manage
that
anything
time,
for anybody else. We don't do any third-party management. We only deploy our resources, our valuable resources, on our own deals that we control.
and during that time, did you ever take on a larger value add project?
Oh yeah, yeah, yeah. We did some major heavy lift stuff, especially when it was more available, 13, 14, 15, than what we're doing now, which is buying A minus assets that we're still finding some value in.
Any major lessons learned?
Oh man, I mean, there's always a ton there. I think some of the most important stuff I could pass on to your audience would be really getting a handle on costs and oh gosh, I mean, it's sorry, I'm not prepared with more mistakes I made. I feel like I could do like a 5-hour podcast on what not to do in real estate, right? It takes a team, for sure. I think that one of the biggest lessons for me, or I'll say one of the biggest value adds, was when I found my business partner about 5.5 years ago, who's the exact opposite of me. Much better operator, much better details guy, much better at running the teams on a day-to-day basis versus me with my visionary head in the clouds. And that really enabled us to scale and bend that growth curve up. That was a major change for our structure and how we operate.
So did you ended up taking on a business partner later on when your business was a little bit more developed?
Yes. Yeah. So 5.5 years ago, who's now my partner, he's president and COO of BAM, runs the entire operation. Him and I have been business partners now for a while. And yeah, guys, he's the yin to my yang, the peanut butter to my jelly sandwich.
That's got to be, that there's probably a lot of lessons learned in that. I mean, how did you even find, if you already had something that was well established, and then to find someone that you're essentially going to be married to in your business, how did you
Well,
create that relationship?
Like all marriages, you start dating at first. I had a guy that I thought was going to be a big part of the company and have equity, and 3 months later, this guy's falling apart because he can't hack it, doesn't know how to grind. One lesson I learned is, the more I work on myself on how to be a better partner, the better partners come to me. But basically, my partner was in the multifamily space as a broker, younger guy. Very smart, was on a 2-man team. He was the brains. The other one was the looks, or 2-person team, I should say. She was the looks. He was the brains. And he was looking to make a move. And he approached me for advice on where he should go. The conversation evolved from there. He liked that I already had a management company, and we started dating. So we agreed to do a deal together and partner on a deal. And through that first, segment of dating, we realized we had a really good working relationship. We both had very opposite skill sets, and I started to give him more and more responsibility within the management company. And at that time, he's still an employee of the management company, but a partner with me on now, I think, a second deal. And then about a year later, we figured out an arrangement for him to have equity and ownership in the management company itself. And he became the president of the management company because he was frankly just so much better at the day-to-day than me. And so it's a pretty popular formula in the entrepreneurial committee. I don't know where that came from. Community or ecosystem to have this visionary / integrator. You guys ever heard of EOS or Traction, the book? Right? You've got the one person that has their lane, and then their opposite, when it works really well, has their lane, and together, for him and me, the sum is greater than the weight of the parts. I think I got that saying at least close enough to what I meant.
That's pretty unique though. I mean, you're already 5 years into this management company. You've had to struggle along the way, hiring the right people, figuring out all the systems, how to do it yourself. So, obviously, you made it past a lot of the initial hurdles that most people would probably have when getting into the space. Why look for a partner so much later when maybe you could have just, hired someone to be able to operate in the areas that you felt that you were weak in?
So for me, bringing in a partner at the integrator level, I knew was a key to bending the growth curve of my company. Bringing somebody up at the top of the leadership food chain that could be a president and COO and run the day-to-day so that I wouldn't have to. Steve Jobs as Wozniak, right? Not every, but most great entrepreneurs have somebody as a right-hand person, their operator, their president. I think, you can't have the yang without the yin. And so for me, it made a lot of sense on how to grow and scale the company much faster than what we were doing.
Were you struggling at all? I mean, with there's a lot of involvement in property management, and not only were you building up a property management company, but then you were scaling your deal size and working with investors. Did you ever feel like things were just like completely out of hand and you just didn't have the right people in place, or did you always have kind of the right person for the things that you were lacking in all along that progress?
No. I mean, it's closer to the first part of that question. Growing a company, especially a small business, is usually a struggle, right? You're very sensitive if somebody quits. If you lose somebody, you're still trying to get systems in place. You're still flying by the seat of your pants most days. And so, was I ever like overwhelmed or wanting to quit? No. As an entrepreneur, you got to learn to get hit in the mouth and get knocked down and get back up. But no, it's definitely a struggle, a grind, some sleepless nights, a lot of 7-day work weeks scaling a company. Absolutely.
At which point did you feel that things started to shift for you, where the day-to-day started to become a little bit less of punches in the mouth, or is that still a reoccurring thing for you?
Oh, now I have to find ways to get punched in the mouth. I got to find ways to knock myself around and force myself out of my comfort zone. The last, I'd say, 4 years or so, I've been continuing to have more and more fun and been able to really focus on more of what I like doing in the company, and getting everything else off my plate. But it took a while to get there.
Do you remember any like key pivot points for you during the scaling of your management company that you thought like, hey, this isn't just me just trying to plug and play a bunch of different systems or figure this out. Like, this is actually going to be a scalable model?
Yeah, I would say all the key pivotal points. If you pile them all up and catalog them, maybe 85-90% are related to people, to people we've found along the way, and key hires that helps us grow the company. A culture starts developing. As you grow, you start being able to attract more A players. You start shedding off some of the B and C players that shouldn't be there. And now it's like watching an organism grow on its own, and I'm like a proud dad. But yeah, in those early days, finding those first key hires that were really working under my partner Adam and me. Certainly, we felt like we had some pivotal moments when we got our first 200 plus unit deal. We bought our first A minus deal. Some big deals that came in that we were able to acquire and raise the equity for. Those were always huge moments. I was an early adopter of Slack back in, I think like early 2014. We started using that, so everybody wasn't getting 100 emails a day anymore. We were a little bit more connected on that. That was a technology game changer. But it really, more than anything else, the people make the difference.
Do you ever have any advice or experience from a bad hire where it actually set you back?
A bad hire that set me back. I'd say there was probably a few of those. If I knew then what I know now, I would have started personality testing people much earlier. For me as an entrepreneur, I've definitely got a few good hires that I could brag about, but I would say overall, I'm not the best at hiring people, because I typically want to hire somebody that I like. And that's not always what's needed, is somebody that's got a similar personality to me. So one thing that helped was putting a couple people that were on our team in charge of finding those folks and giving them the authority to make some of those hires, and then they're also accountable for it. Going from a solopreneur to having a lot of people in a company, the hardest transition for the entrepreneur is the entrepreneur themselves, right? You have to go from wanting to do everything yourself to sometimes slowing down and taking more time to do something because you've got to train somebody else to do it, right? Or instead of fixing somebody's problems or giving them the answer, you've got to let them make some mistakes. Tim Ferriss had some really good content on this called like letting little bad things happen. That was really helpful in growing my company and sort of letting go a little bit more as an entrepreneur. It cost me some money along the way when people would make mistakes. But if you don't give that room for a leader or a future leader, right, to make some of their own mistakes and learn some lessons the hard way, make their own decisions, then instead you develop this habit where everybody comes to you for the answers, and that's unsustainable.
How do you know what type of things are okay to maybe not have up to your standards? Like maybe, you went into this with a very high expectation of everything, but now when you start trying to give that responsibility to other people, it's not maybe going to be at that same level. How do you know which things to pick and choose to let go of?
Yeah. Am I answering for you, Julian and John, or for your audience?
It's this show is about me asking the questions that maybe I'm having internally. So
No, I love it, man. I love it. I want to tell you, like, I love the line of questioning. You're never going to figure all this stuff out before you do it. So much of this is just rolling up your sleeves and trying. And I call it, tinkering, right? You just got to try stuff out. If it works, repeat it. If it doesn't work, pivot, try something else. It's just it's that trial by fire that every entrepreneur goes through. And if you try to figure out exactly like all these little these little details ahead of time, a lot of times you get stuck in that analysis paralysis. So for me, it was really, again, just, I don't have a list in my mind I can give you, man, but and I'm happy to talk more about this one-on-one, but a lot of it is just trial and error, seeing if something works, and if it doesn't, trying to figure out something else. Right. It's kind of like being in the special forces. You got a mission, you got to accomplish it somehow. There's not a lot of instruction. You just got to get the goal, right? And, it's do or die. You figure it out or you die.
A lot of people, that we have on the show, they're not vertically integrated. So, they'll maybe just focus on, raising capital, finding the deals, everything that has to deal with the asset, dealing with investors in the asset management side. But where do you see? Do you believe that it's easier to focus more on finding the deals, dealing with the investors, raising the equity, or is property management a little bit easier to maintain?
Ooh, it's a good question. I don't know if one is easier than the other. I don't know why I just thought of this, but I mean, this Les Brown saying just keeps rolling around in my head. And if you do what is easy, life will be hard. And if you do what is hard, life will be easy. And I've heard him say that just so many times. And I think there's nothing wrong necessarily with, trying to be a capital raiser and co-sponsoring deals with others, or you're going to do this one thing really well. If that's what you want, great. But everybody's got to ask themselves, what do I want here? Do I want a company one day, right? Do I want to have 100 employees? Maybe you don't, right? But if you do, you gotta have some sort of idea of how you're going to turn what you're doing into a business, right? When I decided that, real estate for me was going to be a business, I had to get down to the business of real estate. And that's when it really just clicked that, hey, I can make a business out of property management. Do I want to do property management in my spare bedroom and answer the phone calls and lease the properties and do all this? Heck no. But if I do what I hate first, if I do that hard thing, then down the road, I'm going to be able to do whatever I want, whenever I want, with whomever I want, for as long as I want. I don't know if I went off topic there, but I hope that helps.
Why do you think that so many people are stray away from becoming more vertically integrated and focus more on, being a co-GP or, hiring a property manager and just focusing on, acquisition and capital raising?
Well, I think one of the reasons why it's really hard. It's really hard. I mean, you guys are doing short-term rentals, right? And you guys manage some of that yourselves?
Yep. Yeah, we're a management company.
Yeah, I think that's freaking awesome. And I think most people aren't gonna put in the work that you guys are putting in, and I think that's gonna pay off down the road. I think in the past, it's been easier to be a capital raiser, or I'm an asset manager and co-GP some stuff. I think moving forward, that's going to be harder. And one of the main drivers to find returns is going to be on the operational side, right? And the operators that know how to execute on the actual operations of the business and can figure out how to scale to do that are going to be able to eke out better returns than the folks that are cobbling a bunch of sponsors together and doing deals. I think some of that's risky as well. Now, you guys might not look as sexy to everybody, in the beginning, but I think you keep growing that and scaling that, you'll get something. You get a much better reward for it down the road. And if you really push and grow and scale, you might make a company that's indestructible one day.
Do you think that because you are vertically integrated that you're able to take a little bit greater risk, or that if things ever do have to come, you have to maybe dip into your management company, or are those two completely separate entities and you just treat them as such?
No, the management company could certainly help the rest of the organization. So we can go a long time without having to do a deal because we have those management fees coming in.
I mean, if you are vertically integrated, obviously, your business is with the management. So, do you ever feel that there's more that it's okay maybe for you to not always have to be searching for the next deal, or have to maybe find something that maybe is a little bit slimmer?
Yeah. So big time. We're able to go a year, 2 years without having to do a deal, and we still don't have to fire anybody. We can still make payroll because we have that foundation of the management company, which was very important to me coming out of '08 when I saw a lot of developers go belly up because their whole business was based on getting the next deal and getting those deal fees. Dangerous place to be when the market turns. And the companies that were more vertically integrated and had internal management were able to weather the storm, in many cases much better. When it comes to getting awarded deals, guys, we know exactly what it's going to cost to run that 2004 built 250 unit project that was built in, I said 2004, right? We know exactly what it costs to run that. We don't have to get a management company to come out and quote that. Lets us move a little bit faster. Maybe I'm a little more comfortable putting down hard earnest money, which is needed these days on those big deals.
You mentioned GFC. How,
Yep.
like the GFC, do you see currently how COVID has had effect on just the overall market? And are you anxiously waiting for things to happen? You're excited for them, or you just think everything is going to go the same way?
Yeah, that's a great question, John. I think we could do a whole other podcast on this. It's nothing like 2008. It's not a real estate crash. It's a pandemic. And beneficially, central banks around the world after 2008 said, oh, man, we can't let that happen again. Next time, we're going to quantitatively ease, liquefy the system, offer lots of money out there to help stabilize the economy. And that's just what they did. They were of the conclusion that they didn't act fast enough in 2008. So they acted really quickly this time to sort of stabilize the economy. And by estimates, we're only going to lose about 4% of GDP for 2020, even though in one quarter, we had like negative 30. So I think the U.S. government, the Federal Reserve, the Central Bank of the United States, did a really good job of softening the landing. I think if you're in multifamily and you're hoping for some blood in the streets sort of correction, I think you're going to be waiting a while. Interest rates are low. Debt's easy and readily available. There's lots of capital that wants to be an income producing residential multifamily sort of income property. Now, if you're a retail scavenger or hotel scavenger, right, and you're more opportunistic, I think there's going to be some more deals to find. For us, deal flow got better in 2020. There was just less buyers overpaying for things. Prices didn't really sort of go down all that much. They just weren't being overbid. So I guess you could call that a discount. But we were finding assets that we could get for a price that made sense to us, which we're very disciplined on price. 18 and 19, we didn't do a lot of deals. In 2020, we'll close on 140 million in real estate.
Wow. And why do you think that's because you feel that it's just people are scared and a lot of maybe...
Sorry to cut you off there, Julian. I think the first part of the year, everybody took a pause, right? And like, oh, what's going to happen? Are people going to pay rents, right? Is the world going to fall apart? Is this 2008 again? And we made a bet, or sort of stayed at the table and said, hey, the Fed's gonna stimulate. Everybody's gonna get a check. People aren't gonna be homeless, right? And so we were able to get some really good deals when people weren't really looking, or they were pausing in a wait to see mode. And then late in the year, we got a few more assets where there weren't out of town buyers flying in with too much money in their suitcase, outbidding me. So like on a $40 million deal in 2019, if my line in the sand is 40 million, somebody's flying into town and offering 42, and I'm like, you can have her, right? In 2020, that didn't happen. We didn't cross that line in the sand. We were able to get more deals, and it'll be interesting to see if that continues in 2021. Interest rates are going to be low for a while. Debt is cheap. And now more people are waking up to the fact that in most areas of the country, apartments, rental housing is still doing well. So I think there's going to be quite a bit of demand out there in the marketplace. It might be tougher to find deals in 21. We'll see.
So, with that, the guys that would be coming into the market and, put in an extra couple million over your bottom, over your line, does that also mean though that there's less money circulating or less investors that are willing to put up the capital, or are you finding it?
No, we've high net worth. So we've got over 300 high net worth and ultra high net worth clients. Ultra high net worth being, 15 million or more in net worth. What we found this last year is more of those investors are rebalancing their portfolios, and they're lessening their exposure to the stock market. They're decreasing their allocation to equities. Bonds aren't really paying a whole lot, and you're seeing this trend occur, a mega trend, if you ask me, in private placement. Not only real estate, but venture cap, private equity, and other sorts of private placement. Because, guys, now more than ever, we as deal sponsors can access ultra high net worth and high net worth families directly via the internet, versus having to go through a middle person, an advisor, or go out there to these placement agents, right? There's a lot more opportunity for us to directly market ourselves if you're a 506c sponsor like we are, to the marketplace. And I think that trend is only growing as more and more of those folks want to have less exposure to stocks and want to have exposure to real estate.
And how are you, you said that you have around 300, high net worth, ultra high net worth investors. How did that just come from a bunch of small wins, or was that something when you decided to change? Like, was there a pivot where you started to gain access to a larger pool?
Yeah, no secret sauce, guys. I've been building a portfolio of syndicated assets now since that 60 unit deal I did several years ago. And you treat investors well, you're open, you deliver bad news, immediately if you get any, you do what you say you're going to do, you underpromise and overproduce, and you have investors that are happy, they come back for more. And they tend to tell a few friends. And then once you grow that sort of that friends and family network, you can find ways to extend beyond that using social media and different channels. Once you're a big enough sponsor, having a track record out there, you can attract more capital. And for us, several of my early investors that I managed properties for ended up selling those small properties and investing in larger deals with me. That was another great source early on of equity capital for deals.
Why did you make it such a big point of the 506c and how that plays into your business? What about social media plays such a big role for you?
If you want to be able to generally solicit, you have to be what's called a 506c, right? And the 506c allows me to advertise anywhere I want, but I can only take on accredited investors that are verified by a licensed third party like a CPA, attorney, or financial advisor.
And do you find that marketing, because a lot of people that are in the syndication space, they'll typically stick with like a 506b just because it's a lot of people that but you're saying that you're going to 506c because you want to be able to find new people?
Yeah, essentially. Yeah, I think once you get to a certain point, you have to evolve again and leave the 506b world behind you and move up to to general solicitation if you want to keep growing that investor base. But no, 506B was what we did, years ago, and it's a great way to start building your syndication business. Absolutely.
You mentioned that technology has definitely helped you be able to market your offerings. Which specific places are you using to do that?
Oh, you have to go find them out there yourself. I'm not giving away too much of my secret sauce today, but you can find me out there. It's not too hard. No, I'm messing with you. There's not a lot of secret sauce. If you get big enough, Real Crowd's a great place to find new investors. It's not the problem solver like some people think, but it's a great platform to get introduced to new investors. I think LinkedIn is a great place to have some. Oh my gosh, what's the word? Not to have. It's authenticity, authority. A little bit, posting on there, being a thought leader. I don't see it as like the number one place for organic introductions, but it's a good place to have a good resume if somebody wants to look you up a little bit more. Are you guys still 506B?
We're 506C.
Oh yeah, cool. Good for you. Good for you. So LinkedIn organic. I'm messing around with LinkedIn paid, but the jury's still out on that one. If you're big enough and you got the track record, the Real Crowd guys are great guys. For getting introduced, and then those folks become your LPs. There's no wall between you and your LPs. They're more of a distribution marketing platform. I'm sure you guys play on Bigger Pockets. That's a great place to meet people. You got to deliver value, to get value there, but it's a good ecosystem as well.
Have you gone a little bit more like with the Facebook ads or YouTube ads with your marketing, or is that something that
we've done a Facebook paid campaign. It had mixed results. I don't think we'll do it again. We might test it one more time and see how it goes. The number one source, guys, for new investors for me always has been and might always be current investors.
Awesome. And want to be able to wrap this up here, but if you could go back in time and maybe change anything differently, what would you do differently if you did have to start from scratch?
Oh man, I don't look in the rearview mirror. I get asked that question a lot. If it all went to zero today, I would start over and do the exact same thing, and I'm sure I would be able to do it sooner and faster, having done it already. But I think that kind of goes back into that concept we were talking about earlier, Julian. I get the question a lot. Well, I got a better answer for you. I would have got into EO. Entrepreneurs Organization. I think one of the best masterminds on the planet. If you can qualify for it, you gotta have a minimum revenue company. But I think it's a great ecosystem for entrepreneurs in general who are, maybe about $1 million a year in revenue is, I think, their minimum in most chapters, who want to scale from there. Wonderful ecosystem. You're constantly around other entrepreneurs that are dealing with the same things. So you're learning in a peer-based mastermind environment, but not everybody's in real estate. So you get these nuggets from industries that are completely outside of your own box, that sometimes you can take back and apply to your own business. That's how I found Slack. Was a young software guy, and he's like, "Hey, you want to come to my office and just see what we're doing?" I'm like, "Yeah, sure." I'm like, "What's this thing you guys are all on?" Right? And now it's like ubiquitous, but back then people were like, "What do you guys use?" And that wouldn't have happened if I wasn't mingling and learning from entrepreneurs that weren't in real estate. So EO would be a good one. Big fan of having a coach in my life in different areas that I want to improve on. So I would have gotten a business coach much sooner than I did the first time around.
And what questions do you have for someone that is maybe at a similar size than you, or maybe that next level where you're trying to go? If you could ask them any questions, what would those be?
Oh man, I spend a lot of time right now on who's the next key hire, who's our next big A player that we're going to bring in different areas of the business. So this year we brought in a full-time vice president of investor relations, super talented person, crushing it on the investor relations side. And we also brought in general counsel. Pretty lucky. He was our outside attorney for a few years at a firm. We had already worked with him for a long time, and he was looking to be in-house somewhere permanently. And so now he's our vice president and general counsel. Another A player, phenomenal guy. We spend a lot of time right now, or at least I get to spend a lot of time on that company vision and who our next key hires are. I still try to get around ecosystems of entrepreneurs where I'm the smallest fish in the room. It's not easy to do sometimes, but just joined YPO, Young Presidents Organization, worldwide organization. I'm a tiny minnow in that ocean of business owners and entrepreneurs. Minimum revenue is 13 million a year, and just very thankful to be in that network and have some people that are way farther ahead of me down that path. I'm certainly not blazing any new trails. I just have always modeled those that have been there and done that. Thank you for asking the question.
Yeah, of course. And what is kind of that next step for you? Are you gonna stick with, like, where do you take your business to that next level? Like, what are some of the things that are going in your head right now, Ivan?
We just closed out our first fund. It was 50 million. We raised it way ahead of schedule in about 16 months. We'll be looking to do a similar fund 2, in 2021. On the real estate side, it's rinse and repeat. We're intensely focused on our niche and doing one thing really, really well, which is our formula, and not losing focus on that. Really trying to get higher grades and being a husband and a dad and staying fit and having a good spiritual relationship. Those are actually more important to me. If I don't have those, it doesn't matter how much money's in the bank.
You mentioned a few acronyms and books back earlier on in the interview. Do you mind sharing what those books are for our listeners so we can read them?
I think I brought up Traction, which is the book about EOS, Entrepreneur Operating System. It has nothing to do with EO, but it's very popular in the entrepreneurial world right now. It's all about a system of scaling a company. We deployed it or implemented it about 2 years ago. Definitely a game changer for how to run a company and how to grow your leaders. What other acronyms did I bring up, John? I said EO, Entrepreneurs Organization, very easy to find. YPO, Young Presidents Organization. Did I do any other acronyms? I forget. I don't remember what I had for breakfast this morning, John.
That's good.
Awesome. Well, yeah, Ivan, it's been it's been a really interesting talk with you. I think you're also one of the first people on here that you're very focused on, like, the entrepreneur. Do you consider yourself more of an entrepreneur or a real estate person? Like, you think that they blend pretty well?
Oh man, entrepreneur first. I've always had the real estate bug, but I had to sort of get out of my own way of, hey, I just want to own these big deals. And go back to, okay, as an entrepreneur, how am I going to grow a business, right? So that one day I do have big deals, but all these other things in my life that are important to me work well, right? Because you can't just keep working harder. I'm less of an entrepreneur than I used to be because I've got a somewhat bigger company now and great people around me that really deserve most of the credit for our performance these days. But yeah, an entrepreneur at heart for sure.
Awesome. Well, thanks so much, Ivan, for taking the time. And if anybody has any other questions, if they want to be able to reach out to you, connect, what's the best way for them to be able to do that?
Yeah, bamcapgroup.com. That's bamcapgroup.com. 317-762-2625. 317-762-2625. That goes to my executive assistant. She'll get us in touch.
Awesome. Thank you so much, Ivan, for taking the time. And until next time, deal makers, talk to y'all later.
Thanks for having me.
Hope you all enjoyed this episode. If you did, please go on over to iTunes and leave us a review, as that greatly supports the show. And if you'd like to be able to connect with John, the community, and I, then come and join us on our Facebook group, the Multifamily Success Network, where you can connect and make deals with other multifamily investors. Go to multifsuccess.com/community.